Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive right in, take a look, see what is going on. If you want to follow me, it's @Finance. And if you want to join our community, finding-value.com. I dive deeper into all these different topics, looking for potential investment opportunities, sharing them with everyone in the community, and sharing my opinions on what's going on in the macro landscape and the companies, what's going on with the companies with conference calls and stuff like that. If you're interested in signing up, we do have a coupon code. Special is the coupon code for a 50% discount on the first month, on the monthly membership, first month only, and a larger discount on the yearly membership. And you could be a monthly member, switch over to a yearly. That's no problem with this coupon code. So starting with Jordan. Jordan's a big precious metals guy. I like a lot of the stuff that he shares. So he says, let's talk breakouts. First, it was gold, then gold breaking out against the 60-40 portfolio and the stock market. Then the inflation-adjusted gold price and GDX and GDXJ breaking out of their bases. Today, we look at future breakouts in the precious metals area. Let's go. So one, we've got a potential break here in the future for silver against the stock market. The silver to S&P 500 ratio is testing a 4-year long resistance. This ratio formed a rough double bottom in 2022 and 2024 and is ahead of a long-term moving averages. But it needs to break resistance for the current strength to continue. Will it blast through or rest for a while? Another one, silver against the 60-40 portfolio. We plot silver above and silver versus the 60-40 portfolio, the bottom one. The ratio closed yesterday by a hair at a 4-year high. A little leg up from here could bring the ratio to testing a 10-year long resistance. Silver breaking that 10-year long base against the 60-40 portfolio puts silver in a position to take out $50 an ounce. So there's the bottoming base that we are putting out against the 60-40, and we really like to get out of that red horizontal line. It is a double bottom. First bottom in 2020, second one was over here in 23 or so, and we're trying to break out against the 60-40, and that just defines. So here's my opinion, guys. I think it's in the bag. Why do I think it's in the bag? Because of interest rates. If you go back in history and you look at interest rates and you price it with silver, silver and interest rates follow each other. Interest rates broke the 40-year downtrend line. So what I think that this is happening here is I think 2000 and 2020 are a double bottom. If you draw a line across here, that's going to be a one big double bottom, a gigantic one. And then we are going to break all the way back up to this level, but that's going to take a long time. It's not going to be in 1 year, 2 year, 3 year, 4 year. This is like decade to 2 decade long move. We had interest rates bottom in the 40s. They didn't peak till 1980. So this could take a while for this to move on up and for silver to outperform the 60-40 and all these other financial asset classes. So take that for what you want. It's not a get rich quick scheme, and you could get rich quick depending on how much money you put in and if you're buying a breakout and stuff like that. But what I expect out of this is a really, really long, gigantic bull market for gold, silver, oil, and everything else commodities related, all hard assets. They're going to absolutely crush it against financial assets. The big question that I think a lot of people have is, well, when will it begin? What does it look like? How long will it last? I think it's going to last a pretty long time. And it's possible that we go into the last gigantic bull market of commodities where financial assets, like the way that everything gets set up in the world we have to completely reconfigure our world, potentially, based off of resource constraints. So I don't know if this will be, how long will it last? Well, it might last the rest of our lives, maybe, where we go up and up and up and up, and we hit resource constraints and energy constraints, and we'll have to develop other energy gathering sources, I guess. And we've never been able to do that, at least historically. We've only been able to gather energy from Earth's deposits or Earth's batteries, which is fossil fuels. Gathering sunlight and gathering energy from gravity, like water or whatever, is a little bit more. We've already done what we can with the easy to get locations. So we need to replace a lot of energy, and I'm sure a lot of it can be replaced through efficiency. But that's my take, and that's a possibility going forward. So, when I look at this, silver is the second most used commodity. So out of the number of uses, silver is number 2 commodity. So buying the physical metal when it's below the cost curve was a no-brainer to me. And I'm taking a very long approach and view on the world here. So again, we'll see what happens, and we'll see if this all breaks out. Inflation-adjusted price of silver. So this is in silver divided by CPI. The inflation-adjusted price of silver is testing a 12-year long base. Silver stocks have underperformed recently and are cheap relative to gold stocks. That is an opportunity. It will start working when silver CPI breaks out from the 12-year long base that we're just underneath. And that's when your silver equities go ballistic. It's going to go ballistic, goose. Silver stocks. Given the standing silver divided by CPI, this is not a surprise. Not a fan of SIL or SILJ. He thinks that SLVR is better. But we can use these for tracking purposes. The next leg up in SIL and SILJ would take them to a test of a 12-year long resistance. And that's that big base that it's been generating and will eventually break through it, that horizontal line. Gold against the S&P 500. As I noted yesterday, a counter trend move is due in gold. And the S&P 500, this chart makes the case. Gold broke out from a 4-year long base against the S&P 500 in March. It will take some time, but the next test is against the 10-year long resistance, that horizontal resistance that we're going to try to break up next. 6 is gold stocks against the 60-40 portfolio. We've noted that the importance of gold's breakout of a decade-long base against the 60-40 portfolio. Big PX is an excellent tracking index for the 60-40 portfolio. So GDX recently broke out of the 4-year long base against the 60-40. Now it's sniffing a test of a 12-year long base. GDXJ just broke out from the 4-year long base against the 60-40 portfolio. It has more work to do. So this is the big long base here, the 12-year long base that we're trying to break out for GDX. GDXJ recently broke a couple of horizontal resistance lines. And now what's next is the longer, bigger horizontal resistance line that's ahead of us. So we are still really early in all of these moves down here. GDX versus GDX, or GDXJ versus GDX. So GDXJ is more of a mid-tier ETF than a junior ETF, but I digress. Ratio is testing a 3-year long resistance. Since the start of 2025, it appears capital has favored GDX over GDXJ. But zoom out, and there's a setup for GDXJ to outperform moving forward. And that's when this ratio goes up, and GDXJ outperforms GDX. That is when you get further along in the bull market. The juniors are going to start to really outperform the seniors. Or in this case, he says it's more of a mid-tier. The summary here, there have been quite a few breakouts in gold and gold stocks already, but there are more to come. Most of the next round of breakouts will be related to silver. Stay patient as these future breakouts do not appear imminent, though I could be wrong. Another thing to think about when you look at this, guys, I think that we're going to see oil and commodities and gold go back and forth. So gold's going to go up a lot. It'll pause and go sideways while oil, platinum, silver, and all these other ones do a catch-up move. That is based off of the market conditions. During a slowdown in the market, think of it as the safe haven asset for gold. That's when gold outperforms. It'll underperform when stagflation turns into just inflation in a growing economy. And then we'll go back and forth between stagflation, inflation. Each one of those movements between, I think we'll see certain asset classes outperform during certain market conditions and others outperform during the other market condition. We saw that in the 1970s. We saw, and I don't know if I can show this that well, but here's the 2 and the 10 yield curve going back. I don't have the 70s though. But this yield curve, when it inverts and uninverts, that's when we can see even during, you could use U.S. housing starts as a proxy for it as well. And then you can put XAU-USD underneath it. And then what happens here is when this goes and turns down, that's like the time to buy. Let me see if I get a horizontal line here real quick. Not horizontal, vertical, I mean. So when this starts to come on up, like that's the time you want to purchase, is like right in this area, right before housing starts peak. And that's when gold starts to turn up. You can see it does it again. You know, it bottoms here. So when you go up, it'll eventually slow down and gold starts to rip higher. And then we had a long consolidation. Coming here, you can see housing starts were coming on up, and you can see it starting to come on up, front running a potential slowdown. And then you can do it here too. Front running a potential slowdown was right here where gold started to turn up and move. And then the slowdown as housing starts fall and the economy slows down, inflation pulls back. That's kind of when gold outperforms. When it heats up, we can use U.S. oil. Now, when this starts to heat up and you start moving upwards, like here, that's when oil starts to get engaged. And then when it comes back down, it'll go sideways for a while. And there's a lag between this move here and the price of oil because it takes, this is the money creation process. And then there's that lag. And then you can see oil was well supplied. It had a big consolidation, and then we had another big move here. So it's credit coming into the system, and that credit coming through the system increases oil price. But I do think in both of these cases, we are going to see a decline in production of gold and a decline in production of supply of oil. And I don't know how we're going to bring it up meaningfully in either one of them. So, and again, we'll see. We'll see what happens. I'll shut up and watch the markets and see what happens in terms of supply. But I think a lot of stuff's going to start to roll over in oil. And I think we're rolling over in production of gold as well. The most ridiculous energy bull market says this is the biggest fact that the 1929 and 2000 boys continue to miss, and why the current market looks nothing like those past 2 major peaks. We haven't seen a 3 to 5 year melt up of greater than 200%, as well as a trailing 12-month return greater than 50%. I'm not saying that we will see the above, but you need to understand the difference between those past 2 time periods and today. They are not the same. And a lot of people are talking about 2000 versus 2025. The one thing I will say, the 2008 crash and the 1929, those were driven by real estate deleveraging. So we had a lot of loans go bad in the system, which impacted the banking system, and it's deflationary. So we don't have the same setup today as 1920s, the late 1920s and the late 2000s. You're not even, to make that comparison, it makes me think that they don't know what caused those market crashes. Those were deflationary and the destruction of credit. and it came from the residential real estate market for both of them. We don't have the foreclosures in the system right now. I'm not saying that they can't come, but I'm much more weary of them coming because we haven't made the bad loans, and a lot of the people that are in homes right now either own their home outright, and then the people who do have loans have a lot of equity in the house. So when interest rates went up and they're higher now, and the affordability is worse, we haven't piled on a bunch of bad loans. So yes, there'll be foreclosures. I just don't think they'll be in the same volume and quantities as the late 1920s and 2000s in terms of percentage of foreclosures. My opinion. Peru says stocks higher as percent sees de-escalation with China. BBG article below states negotiations haven't even started yet, but that a deal is possible. This administration has turned the stock market into a headline-driven casino. That's true, though. They have turned this into a headline-driven casino. Interesting. Value theory, it says the key to making money in stocks is to not get scared out of them, says Peter Lynch. And I've shared that one multiple times, but there's a lot of truth behind it. Given says TLT upside down. Long bonds look bearish. USA prospects of paying debts with taxes versus defaulting on debts by printing them away is bearish for bonds. Yield curve control will come. Dollar will fall. Inflation will enrage the poor. So this is inverted. TLT inverted. This looks like it's trying to break to the upside, but since it's inverted, bond prices are trying to break downward. So that means higher yields and lower bond prices. This also means that we're going to see money fly into gold and silver and commodities. Urine Timmer says, for now, the 1998 analog continues to hold and shows a textbook pattern for a normal 10% correction, giving way to an impulsive 20% decline, then rebounding, but initially failing. There's too much up and down here. Calm down. Let's just look at the chart here. So, scene of the crime here, we fell on down. It looks like we're trying to put in a double bottom here. And what he's saying is this is very similar to 1998, which is the blue line, versus 2025. And you know what else was in 1998? The bottom of commodity to stock ratio. So yeah, this could be a great area to compare to. And he's saying that we could see a double bottom here. And this here is, he doesn't have this labeled. I don't know if this is the S&P 500 or something else. He doesn't even have the chart labeled of what this is. But anyway, there's a strong comparison of whatever that chart is. It's probably the S&P 500 compared to 1998. That double bottom perhaps coming up here. And I think that will happen. I think it'll happen in a bunch of different areas. I think silver is going to do it. I think platinum, I think palladium, I think all of them. And it's that big drop here where you might get a double bottom. Warren Buffett says, don't pass up something that's attractive today because you think you will find something better tomorrow, says Warren Buffett. And I hear that a lot. If we're down and something's very attractive, people will say, well, it's probably going to go down even more. And then they wait, and then it goes up a lot on them. So what I do is I try to cost average into positions. I don't just buy everything at once. You can get good pricing doing that. You could maybe get better pricing, or maybe you get worse pricing, but at least you kind of hedge yourself. Buying everything at once means that you're trying to time the market. And timing the market is proved to be very difficult. And Warren Buffett is literally saying that. Here's another one with the most ridiculous energy bull market ever. I'm with Josh on this trade. Few, if any, investors own any real size longs in the oil and gas space. I do. He had a survey he posted of 124 oil and gas executives, and exactly 0 of them predicted WTI prices to be greater than $100 in the next 2 years. When I look at this almost 20-year base of crude prices, I see an event in 2020 that exposed just how much the volatility in crude prices has left the oil and gas space susceptible to shocks. A dearth of investment by oil and gas companies over the past 15 years has created the space that will cause a major upside price shock in the coming couple of years. A measured move on the base like this puts an upside target of $260 a barrel of WTI. I might not be around for the entirety of the move like that, but I'm certainly looking for new all-time highs above the June '08 high in the high of the 1940 or 100 in the high of $140 a barrel. While everyone focuses on gold right now, while Trump's tariff tantrum slowing global trade, oil is the real commodity that you should be loading up on. Clarity will emerge, and major investment in infrastructure and factories, along with the troughing out of the Chinese economy, will drive oil prices significantly higher. Don't sleep on oil, in his opinion. So what I think is occurring, you see this move here in 2001, and see how that's coming up in the black there. I think that's right where we're located. Is this general location, and that's exactly where we're located right here. So we're in this general area here of where we are up here, and this could be a big shoulder head, and then we're scribing out the right shoulder, and we're at the bottom of the right shoulder. So it's an inverted shoulder head shoulder. And I agree with them. I think we're going way higher, way higher. I don't know the exact price. You can get ridiculous numbers when comparing it to gold. If we were to go back to a low ratio like the 2000s, you get some really, really high numbers for oil price. Gold is ready to pass the baton to silver. So this is panic, which I agree. And then we'll turn over and silver will outperform gold. And this is the mistake that a lot of retail investors make is they chase price performance. You want to chase value. The value in the market is in oil. It's in silver. It's in platinum. That's where I would be buying hand over fist. Now, I've been buying that for a while. I didn't play the gold move up here. I've been playing the eventual move where the fear subsides out of the market, and I'm going to play the big move in oil, in silver, in platinum, in those types of areas. I think they have a lot more upside potential than gold does, given where the ratios are located. I'm not trying to time anything in the short term. I think that proves very difficult, and a lot of mistakes will be made because the person has to make a lot of decisions in terms of buying and selling. What I do is I try to focus my efforts on finding the best companies, getting good entry points, and just buying the crap out of it for this big bull market that we have entered. Here's the state of oil from Eric Nuttall. He says, global oil inventories remain at the lowest level since at least 2017. Oil price is undervalued by $17 a barrel due to reasonable risk of a global slowdown. Oil demand in April is up 1.5 million barrels per day year over year, and we're not seeing weakness yet. Financial demand for oil is the second lowest level in recorded history after the largest weekly drop in financial demand in history. Everyone is throwing in the towel with the 25-26 demand forecast cut and 2026 builds widely projected. By the end of 2026, even with modest demand growth and an increased OPEC plus production, U.S. shale losses should turn into days of supply well below average levels and good progress on normalizing OPEC spare capacity to 2 or 3 million barrels per day. Within the next year, we believe the twilight of U.S. shale will have become mainstream, and OPEC spare capacity worries will have been largely eliminated. And this is global observable oil inventories onshore and oil on water. It is coming up a little bit here recently. Then we've got global oil days of supply, and you can see we came up a little bit the past few or no, these are projected. Sorry, we've been coming down. The projections are that it comes up a little bit in 26. That's what they are projecting. Doesn't mean that's what will eventually materialize. David Saibunka of Canoe, I love it, or Canoe, however you pronounce it. Commodity cycles are 15 years long. We are in the fourth. A lot of room to go for Canadian energy names. He says buy Tourmaline, Prairie Sky, and Topaz. I like other companies, but Tourmaline's fine, but I like other ones than that. Eric Nuttall, this is from Halliburton's Q1 conference call. Many of our customers are in the midst of evaluating their activity scenarios and plans for 2025. Bernstein, a 10% drop in drilling, 44 rigs from current levels, equals a 0.5 million barrels per day production decline. That's equivalent to a 0.5% drop in global GDP. And this is shale production by quarterly wedge, and they have it basically going sideways out in the future the next couple of years for shale. Will it decline? Will it go sideways? Tough to say, but that's what they're projecting, is just a flat production for the next few years. Parallel System says only 1,000 tons of gold, coins, and bars are available for investment each year. Just 100 billion at $3,400 an ounce. As capital flees the dollar, there's simply not enough gold to go around. The price must rise, and it is. Gold isn't just scarce, it's insanely scarce. There's also far more scarce options in precious metals like platinum and palladium, and obviously rhodium too, that are far more scarce than gold. But gold is what we use for a monetary asset. And then he's got it's basically the Exter's pyramid. So derivatives and unfunded liabilities, and then it just goes all the way down. Commodities owned outright, and then land. And this is your default risk going down. Freight futures, AM update. We've got some down moves in dry bulk and tankers. Capesize Panamax are down, and tankers are down, all about 2%. Winston Wolfe says the opportunity ahead for silver is incredible, life-changing, in fact. And the way that he's got this drawn out for these downtrend lines is that silver is breaking the downtrend line, not the horizontal line, but the downtrend line against the S&P 500. In my opinion, this will turn out to be a double bottom, and then we will outperform the S&P 500 for a very long time. Silver will. This is not like what people have experienced. What people are doing is they're going to compare it to 2000 to 2011. That's the wrong comparison. It was in a declining interest rate environment. This environment is in an increasing interest rate environment. Two very big different distinctions. When interest rates went up through history, silver went into a large bull market. I would say if you look at the silver price, this is your silver price. Make it a little bit easier to see. So this is silver here. This was an increasing interest rate environment. Your cup and your handle, this here was a decline of interest rates during the consolidation. This was a decline here of interest rates. What I think is coming is increasing interest rates, and this is going to break out of the 45-year cup and handle pattern. And interest rates are going to go up with it. And why is this such a significant thing? Why am I so fixated on interest rates? What that means is that when interest rates go up, and if they go up to a certain level, above 5% is the critical level if you want to know, you're going to start to see selling pressure in multiple asset classes. You'll see it in the stock market, and you'll see it in the bond market, simultaneous. The other bull market, this one here, that was not that same condition. Stocks were struggling in some of these periods, but the bond market was still a viable option. And interest rates were still in a declining interest rate environment. This here, I don't think is going to be anywhere near what I think is coming over here. We are going to launch out of this as a launching pad. So this pattern here is going to be a launching pad to a whole new paradigm. And it's going to be driven by the interest rate going up and breaking out of its 40-year decline. So there's the interest rates. Silver went up here, and then silver's going to go up here. And that's what those green lines indicate. Down, up, down, up. And this is the driver. It's not something else. So that is what's going to drive this thing to the moon. And this is responding to this. So now everybody thinks this happens very quickly. You have to change the mindset of everyone from a 40-plus year decline of interest rates. This is going to take time, and it's going to be a big rotation. And then once people get on the right train, then you're going to start to see people start moving more and more money into precious metals and away from the bond market. And if you want to look at the bond market, this is bond prices. This is an end of trend shoulder, head, shoulder. This is called a head and shoulders pattern. That's an end of trend move, and we are now in a declining interest rate environment. And if you went up above, Kevin Bamberl said that this is trying to break down to the downside. And that's money leaving the bond market. It's money eventually will leave the stock market, I think. And stocks will trade sideways. So stocks will do this big sideways action during these commodity bull markets. So that's what stocks will do coming forward. There'll be a sideways action like that. So that's what my opinion is. And this will be a very big bull market for commodities. It could be a game-ending one, depending on resource constraints. So I don't know if it is or isn't, but we'll see what the resources look like. Peter says, if this is a start of the currency reset, we are 50 plus years since the last major reset. Then $3,400 an ounce gold is a fraction of the monetary reset value. This is why you never ever sell all of your gold. Never. Especially not under current global circumstances, decades in the building. So gold is surging on the coming monetary reset, but most think they have missed the trade. The real miss is mistaking revaluation for a trade. Early days. It's not a trade. Trump's trade war hits small businesses. Basically, what we're doing is eating our inventory and hoping that it will last us until this gets settled, said the CEO of Basic Fun, a Boca Raton, Florida-based seller of children's toys. If it doesn't, we'll be out of business. So a lot of the small businesses are feeling it pretty rough here. A lot of businesses outsource what they produce, and then they sell it here in America. They outsource it to China, and China's getting hit with these large tariffs. So the tariffs are paid by the businesses, and the businesses can't afford to bring them into the United States. There's not many options here to build it in the United States because we don't have the capacity, the tooling, the manufacturing, all that stuff. Happy Wine says, the fact that gold can go up 2 to 3% every day without fail for weeks on end does mean that when silver finally, actually, eventually, someday, in due time, does break out, it's going to absolutely rip 4 to 10% daily and relentlessly. Until then, I'm just a silver fool. I agree. And the time to buy silver is, in my opinion, is now. It's cheap against gold. It hasn't broken out of that big cup and handle pattern that we were just talking about. All of the background market conditions are ripe for precious metals to go up. And that's the interest rates that I'm talking about. Some of these other cycles, the debt cycle, the K-wave, the real estate cycle, all those things. It's coming, and it will be a big, big move. Like a life-changing move will transpire from all of this. Triangle Investor says we have a situation where the long-term uranium market is essentially broken. We can expect from experience that supply shortages will only be exacerbated by likely delays and underperformance of the sector generally, says John Borshoff. Okay, that's pretty profound. Peter Schiff says, for years, when U.S. stocks went down, foreign stocks went down too. But tonight, most foreign stocks are up. Many are making new 52-week highs, despite today's huge sell-off in U.S. stocks. That's because money is moving from U.S. stocks into non-U.S. stocks. This is the new normal. That's the increase in interest rate and potentially weaker dollar, which is it's a different paradigm that we haven't seen before. John Cooper says it's quite clear at this point that Trump is intentionally trying to harm America's economy and our global standing. The damage is so broad and so deep that it simply can't be accidental or inadvertent. It must be deliberate. The only question is why? That is a great question. And I think very similar to him. It's like, why did he do this? Why did he put all these large tariffs without really giving people the heads up? Why did he do it all at once? Why is he doing all that? There's a lot of whys. I don't know the why, but kind of interesting. This is Javier. He says, how do you say drill baby drill in Mandarin? Call it, I don't know, that. China may not have a drilling slogan, but it just lifted oil production to an all-time high, surpassing a peak set 10 years ago. So they are increasing oil production in China. I know that their demand is going way up. And they have very low inventories. So I think that's one of the reasons why they're moving production up. OPEC spare capacity reported at 5.2 million barrels of oil per day. Iraq is purported to have 600,000 barrels of oil per day. Look at the chart below. Does it look more like 600,000 barrels of capacity or 1% natural decline? OPEC does not have 5.2 million barrels of day spare capacity. I agree it doesn't. And they're cheating. So I don't know what the spare capacity really is. If I were to guess, I'd say 1 to 2 million barrels per day spare capacity. And we went during the big move higher in the year 2000s. We had like 1 to 2 million barrels per day spare capacity, and inventories were increasing slightly. Now, everybody thinks that we have this large spare capacity. It's giving you a gift to buy this when it's cheap, in my opinion. When people figure out that we don't have 5.2 million barrels a day spare capacity, that's when we'll move. And it could be a very big move if people realize that the capacity is much tighter than what most people think. So we'll see. Now, we do have surge capacity. The capacity of 1 to 2 million barrels per day is the spare capacity that is stable. We do have surge capacity above that, which might be 1 to 2 million barrels more than that. And that's surge, which I think they can surge to, but they can't hold it up there for long periods of time. Here's one from Grady. This is not an ordinary market move, so we cannot use ordinary measuring sticks to understand the move. This is gold starting to reclaim its role as a safe haven and front-running the coming monetary reset. And this is not a standard market move. This is fiat currencies depreciating and gold being revalued. We are now seeing new all-time highs every week. Said when called the 8-year cycle low back in 2022 in real time that a pink breakout was coming soon. Then said when posted on that pink breakout that a historical lockout move without backtests is likely. Then said it looked likely that the gold would just blow through the blue line and not be stopped by it. It is extremely important to recognize the new market environment when things change. So that's what he's saying there. You know what's going to do this next like this? Silver. Silver's going to do it next. So everyone's going to wait. They're not going to buy silver. They're going to wait until it breaks out, and then it's going to go straight vertical, and then they're not going to want to buy it because they want to buy it on a pullback. Good luck on that. I think it's going to do something very similar to this. Silver will. We haven't broken out of that line. We're still in this kind of area through here. And once we get breaking out through all this, I think it's going to just rip. So there's your chance in silver. This is the capex for the last 5 years for 9 big oil companies. Aramco's on the left. One of these is not like the others. Hint, it's the one that claims to have 3 million in unused oil production capacity. So what's happening here is capital expenditures are remaining pretty stable. They're not really increasing very much over these years. Pretty flat for BP. A little bit down this year for Shell. Why is Saudi Aramco increasing their capex spending massively if they've got all this spare capacity? Why is that? Maybe they don't have the spare capacity that they state. I also know that they're ramping up in natural gas. There's a lot of spending occurring in natural gas as well. So there is that in there too. Another one from Grady. This is silver. This is the very reason why silver is churning now. Because right here is the big breakout level using the yearly time frame. Huge resistance takes time to overcome, which is to be expected. One of the most significant breakouts in history is finally in the making for silver. The mother of all very probable cup and handle, the bigger the base, the higher in space, the increasing interest rate environment, the gold run that's already occurred. Guys, this is a freaking layup. It's a GD layup. It is a freaking layup. And everyone is, I don't know if they're positioned in this move, but this is a layup move, guys. Gold's our leader. Silver follows. We're at huge resistance. We're trying to break out. And then when it breaks, it's going to unleash. Looks fantastic. So that's, and here's Kevin. He says, as much as I love gold, the outperformance has me looking at silver and oil. I think oil is going to follow too. Silver and oil are going to just rip. It's going to be one heck of a move. But that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Use that special coupon code. I'm releasing a midweek update today, so check that out. It's already posted on the website here. And it goes over some of my favorite companies in all these different sectors. In silver, oil, in energy service, gold mining companies. There's other stuff I have on there too. Steel, iron ore, diversified miners, dry bulk, tankers, a variety of things. So if you want to sign up, use special as the coupon code. Check it out. We have a Q&A session coming up this next weekend. It'd be Saturday in the morning at 7 a.m. Mountain Time. But that's what I've got for today. We'll catch you next time. This is Finding Value.